For those who are here for the first time, we want to just share a little bit about some of our numbers. Our business is dedicated towards driving entrepreneurs toward financial peace, helping them gain financial clarity and control. We are a team of experts all over the world, really. Some of us are based here in the US. We have a team in India. We have someone in Malaysia right now as well as the Philippines. And our clients come to us for a variety of reasons, but especially cash flow, profitability work, and financial strategy. We also help keep the numbers in line with monthly bookkeeping for a lot of our clients as well. These workshops are really meaningful to us. They're a moment in the month when we get to come together with our wider community who aren't part of our one-on-one services, although occasionally our one-on-one clients hop in as well. And we really love being here and helping increase your financial awareness and understanding and sharing Michelle's brilliance with you because she brings a ton of experience to the table.
All right, fantastic. So, as entrepreneurs, we start our business and we're like, all right, what's my exit strategy? And typically, it's going to be one of these two things in your head. Like, or mainly, we say, oh, I'm going to build this thing and I'm going to be like all those big tech companies or Facebook that they just sell it for millions of dollars. But sometimes it ends up just in a dead end. And it's very interesting right now because we're seeing a lot of our baby boomers as they're exiting the market to be like, what do we do with this business? And some of them are just saying, it's all right. It did what I needed it to do, and I'm fine just letting it go by the wayside, which is not what we want. That's not what we want. So today, our the whole goal for today is to truly go in and say, what do I need to be doing now so that my business is worth something that people want to pay for? There are many ways at the end. The truth of the matter is, we're all going to die one day. That's just the way it's going to be. And so, when we look at our businesses, what we would like to do is have a plan in place so that we can do something with our business before that day comes, like when we want to retire or when it has served its purpose for us or whatever else might be. So I just put some examples here of ways that you can move your business out from you to someone else. And they could be a myriad of different ways. So that's not what we're going to go into today, but just this is to let you know what the options that may be available to you when you are at that place where you're ready to be done. And it's so interesting because some of you have shared that you've just recently purchased businesses. And so perhaps it would be interesting to know why you purchased it and what pieces did you see when you bought the businesses that you bought, especially when it's not when it's an entrepreneurial business that you purchase. So these are the areas where why somebody would want to buy your business. And there sometimes we see businesses buy another business because they can't hire anyone. So this trained workforce is really huge. We see this in some specialized marketplaces where they just cannot find anyone. And so they buy another business in order to get that workforce. But all of these are potential reasons why somebody would buy your business. What we are going to go into today are the pieces for you to identify where your value is and where your risks are. And we're going to cover three areas right here: profitability, growth, and stability. So we're going to start off with your profitability. Everyone is very familiar with what your revenue is, how much money is coming into the business. And then we've got all of the expenses that go along with the business, but the bottom line turns into what we refer to as your net income. And this is just on a financial statement. So the top line is the revenue, and on your profit and loss, the bottom line is the net income. But then we have this beautiful word right here that gets just spread around all over the place. What's your EBITDA? What's my EBITDA? And when we've got a client that comes and says, Michelle, I need to know what my EBITDA is, my first question back to them is, where'd you hear that? And why? Because I see calculations all over the place that mean different things. So today we're going to take it from the viewpoint of a fractional CFO and a bookkeeping company. But I am not a broker that buys and sells businesses. I'm not in acquisitions or mergers. I'm not an attorney either. So the principles that we talk about today are fundamental principles for then you to ask the question, why do you want to know your EBITDA? Or why is somebody else asking you what your EBITDA is? And a way for you to explain how you came up with this number that is called EBITDA. So, is obviously an acronym meaning earnings before interest, taxes, depreciation, and amortization. That's what the acronym stands for. And the best part that I can point out to you is this earnings. It's not the income, like a net income, it's the earnings. And we'll talk about what that means as we go forward. So, oh, here we go. I should have put it here. This lets things be standardized across industries and across to strangers. I kind of think of this as the SATs or the ACTs for college, for high school graduates, is that you could have gone to a private school or a small school or been homeschooled or a public school, whatever it might be. And so what we do is we've got a standardized way of looking at the knowledge base of a student. And that's what the SATs and the ACTs came out. This was a way to say, what is that, regardless of where you live, what type of education, but really what is your smarts? And this EBITDA is a way to say, what does my business look like if I'm not the one in charge? And when you're an entrepreneur, we sometimes put things through the business as far as expenses that may or may not continue after you no longer. So it's where investors look at it and where potential buyers may look at it. It's not something that financial institutions look at, like banks. So just know that as well. That's why I usually ask, who is asking the question to get your EBITDA? Unfortunately, I see it a lot in divorces because they want to see how much the business is worth, and a spouse who's soon to be an ex-spouse thinks it's worth more, and the person who owns the business thinks it's worth less, and so you get to a place where it's like, these are what is the true value of the business, and they start off with this EBITDA number. All right. So in this exercise, and you don't need to do this right now, and the recording will be sent to you, but we start off with grabbing your profit and loss statement. And sometimes it's called an income statement, but we refer to it as a P&L or at a profit and loss. And what you want is a full 12 months. If you're on a fiscal year, then you grab the last fiscal year. If it truly is, you've got the last 12 months that you've got, grab that. Whatever's the most recent data is really where it helps tremendously. However, sometimes we just keep it on the month. Like right now, we're in the month of August, soon to be September, and we're far enough in the year to grab a lot of what this year would be instead of just going to 2024, because we've got 8 full months of business. So you grab this. So I just grabbed an example of a sample profit and loss. And the first thing that we do is we look at what is our total revenue. So that is right here, all of the money that comes into the company. And now we start identifying some things along the expense item that need to be grabbed and taken out in our calculation. And one of those things is depreciation. As you can see, the word EBITDA is earnings before interest, depreciation, taxes, amortization. So here I found the line item that says depreciation. I highlight it. And then I've got taxes here. And one other thing is that what we take out is, how much did you pay yourself? And the reason we do that is you're going to be gone. and a new owner is going to step in, and they were not going to have to pay you on a monthly basis. And so this is how we get from a net income to an earnings. Think of it in the sense of, hey, I want to buy a business. How much should I be able to pay myself? What are my earnings going to be? So when we do bookkeeping for clients, we are always pulling out the owner's wages. And if you've got two people that are owners, you've got to pull both of them out. Whomever is no longer going to be with the business once it sells. And sometimes there is a little bit of a carryover, but most of the time the owner is gone. That's why they sold the business, to be out, to no longer have to work or do anything. And so the owner's wages are not what you take out of the business that's on the balance sheet. It's truly just what got run through on the profit and loss. Because again, we're just looking at the profit and loss here. Then if there is amortization in here, or if there is interest, and why would there be interest? That's because you've got debt that you're paying on that may or may not continue once the business is sold to somebody else. Then you get down and you get this number that is the net income number. So when the other pieces that you may want to look for is off of the P&L is ask yourself the question, if I did not own this company, would the new owner have to pay this amount? So I see people that buy, that they run some things through that are personal expenses that run through because there's a little bit of a gray area there. Or we had a dentist once that he moved out of California up to Washington, and he came down once a month. And so he would come down once a month, and they would fly him in to then come in once a month because his expertise was so great. But that no longer, a new owner might not have to pay for that if they don't need that person anymore. And all of those travel expenses wouldn't be there anymore as well. So at this point, you may have to go way deep into, well, what is professional development? And perhaps you are someone who truly values constantly learning, taking classes, paying for coaches. You might say, you don't necessarily need that. This was just for me because I realized that I wanted to learn more about something, but that could be taken out. So at this level, we're taking a whole line item, but beyond this number of $1,655.34 are a whole bunch of charges that we could see, and maybe you take out half of it or the $600 or whatever it might be. So you really have to ask the question, if I don't own this, would the next person have to? We see that also with spouses that are part of things. And so perhaps the cell phone for the spouses covered by the business as well, that would go out. I want you to think of what you may receive because of a relationship that you need to pay attention to as well. That say, okay, well, it's my son that's providing all of the repairs and maintenance. But if somebody else owns it, then yeah, they're not going to give you that discount or benefit or whatever it might be. We also look at why these items for the balance sheet are not included. So we don't include the value of assets or the value of vehicles. We don't include the value of business equipment in the EBITDA calculation. And we also don't look at debt unless that's part of the negotiations that take place. But that's not part of your EBITDA calculation because most time that is a negotiated piece to say, do I have to have this debt? And debt's supposed to go away. Like we're supposed to pay it down and have it go away. And we're trying to say, what is the business worth right now if there were no debt? We also don't look at what the equity is, and that is what you might run through the business to pay yourself or the retained earnings. None of that comes into this EBITDA calculation when you're valuing. So again, I put this EBITDA over here of interest, taxes, amortization, depreciation, and then what other things that you might not have to pay. I also want you to think about, in this case, if the new owner, and this is where you start looking at like, well, who is owning it? So in the case of a dentist, in the dentist office, a new dentist was going to acquire in a new area, and this is going to be an additional location. Well, you don't have to pay for another dentist certification. He already has it. So there, though it's a legitimate expense of the business to pay for the licensing of a dentist, if the new dentist is purely just acquiring, then you're not going to have that additional expense. So this gets down kind of granular, but in each of these cases, we're taking that, hey, what's my earning? What is my revenue? And let's take out all of these expenses to get to my bottom line and that's what we call the EBITDA. So I did not do the calculation on here, but you can do the same thing. Again, you take your revenue and then you start subtracting out all of these pieces that I just went through. What you pay yourself, the taxes, the net income, anything that you might have, and you come down with a new bottom line that says, this is not my net income, this is my EBITDA number, whatever that might be. Now, when looking at the value of your business, you also want to do this for prior years or the prior 12-month period, because then you can see, hey, what's going on here? Is it to the positive or to the negative? I'm going to go back to the dentist office as an example. They had an amazingly strong EBITDA and then COVID hit. And what happened during COVID? You couldn't go to the dentist because the fear of spreading the disease was so strong. So dentists closed. So what that meant was the revenue just dropped. Some of the expenses stayed the same. And if they got a PPP loan, then, or the funds that was the grant, then they could continue to pay their employees, but that wasn't a natural time period. Well, what happened after COVID? We had a lot of people that were out. They decided to retire during that. There was a great resignation that took place. So in this case of the example that I'm using with the dentist office, their EBITDA just plummeted all the way through 2024, and it wasn't the same as it was in 2019. And so we had to go back further than the 4 years or even the prior year to show, hey, this company is worth more. It just was some of these other circumstances. And it's really good for you to watch this as well, just to say, hey, what is my EBITDA doing? And where would I start a negotiation with someone based upon what's happening? And we're going to go through some of these other things, but if the tariffs affect you, then you might see that change there as well. So we want to see a comparison of what the trends have been.
I have a
Okay.
question.
Yes.
Um, so on the taxes, I've got sales and use tax, I've got payroll taxes, property tax, estimated income tax. Um, are all those included?
Nope, that's a
Okay.
great question. So the kind of taxes that have to stay in are the payroll taxes, because you see up here how we've got payroll tax because I've got wages, and you're always going to have wages that you're going to have to still have employees, but you can take out the taxes you paid off of your owner because that owner's no longer going to be in there. You're thinking of it through the lens is, will this tax continue if I am no longer the owner? So in the case of a franchise tax, that once the owner is gone, that would be go away. But sales tax will not. Sales tax will still be there and the thing is, on your profit and loss, sales tax is not included. That's a balance sheet item. And
Right.
so sometimes if it's on the balance sheet, then you're not going to see it. And then you can kind of say, hey, if it's not on the balance sheet, it's not in any of my calculations here. But the thing about taxes is that you might be married, the next person's not. You might have other investments or own your home or not. Your personal taxes that you pay as in your business are going to vary based upon your current situation. So we take that out of the equation. Tracy, did you have a question too?
I do, yes, thank
Okay.
you. What about, I'm going to assume like, okay, so if somebody were to purchase a business, a lot of times it's a larger entity buying a smaller business to roll up under their umbrella. So can
Yeah.
you also strip out like professional services like accounting, bookkeeping, things like
Yes,
that, assuming that they're going to
absolutely.
have all of that themselves?
Absolutely. That's a
Okay.
great question. So, yes, if there's anything that's going to go away, then yes, you would do that. So maybe you don't have to have another salesperson. Now, you have to think of it in like if you are the seller, then you're going to say, oh, you're not going to need that anymore. And you're going to take it out. Because what does that do? It makes the bottom line get bigger. Oh, you can take this out. You can take this out. And again, this is about buying and selling a business. It's the negotiation that takes place. And
Mhm.
so when you are approaching it as the seller, you're like, you're not going to need this anymore. You're not going to need this anymore to make the value go up. Well, if you're the buyer, guess what? You start saying the other game. Well, I'm going to need to keep them for at least a year. And I don't know if I have anyone that is that good. And you keep it there because then the price goes down based upon EBITDA.
Yeah, and I've heard too, though, from people that if you really are considering getting closer to a sale or an exit, that it's smart to stop running your travel through your business, to stop, just to make sure to start paying for those kind of things personally, just to kind of strip it out to show and illustrate that your business can run without those things.
Absolutely. Absolutely. Because the more, and we're going to get into this, the more that somebody can trust your data, the more it's worth. And so a new buyer, if you're trying to take expenses out and you have that, well, you won't have to have this and you won't have to have this. What does it do? It makes them really leery of you because we're talking about this isn't science here. It's some science as far as calculations go, but the rest of it is okay, well, what about this? I was thinking like a great example is how much is a car worth? Well, the car that has been a used car that's been driven by a teenager versus a used car that's been driven by a business person or an elderly person. Same car, same year, same mileage. Which one do we all want? The one that an elderly person is driving because they're going to be nicer and everything to it. So we're looking at this with the business as well. Think about the other piece of buying a car. If somebody comes, my grandfather, he just kept every receipt and everything on his cars. This is when I had the oil change. This is where I got the tires from. I mean, he just had a log of everything. Do you see how that car might be worth more because you've got all of that data that you can trust and you feel like it's more reliable? So that kind of goes along with it of what is being run through the business. The flip side on that is you might end up paying more in income taxes because you're not writing things off. And so it's a conversation to have with your CPA to say, hey, where's my benefit here? And where am I in the trajectory of owning this business? And am I thinking about selling? Okay, I want to truly take some things out. All right. Okay. We're going to move on to growth right now. And this is truly one of the areas why businesses get those high price. What we see a lot, especially in the technology arena, is how many clients do you have and how quickly is that changing? So when you see these big deals like so and so paid $1 billion for this software, it is truly because they are seeing the amount of users that it is attracting and they know, hey, people are flocking to this and I'm looking at the growth. So when you look at yours, we already know the revenue and we've already talked about those pieces of that equal sales and expenses. But now you're going to look at your business from the standpoint of how many clients do I have? Can I name them? Am I retaining them? And something like in e-commerce, we might not ever know that because the list is just long, long, long. But this is something to show for a potential sale of I have this many clients and I expect to retain them year over year and I can show you. We have two calculations that come into this that are really nice to show when we're trying to value a business. And that is the lifetime value of a client and then the client acquisition cost. So what we do for the lifetime value or the retention of revenue is to say, how much revenue do these clients or customers generate for me? And how many are the same customers remain from year to year? And we want this to be more than 80% in the industry. And sometimes it's not like that, but that really adds a lot of value if you can say these are the same ones that I had from the year before. And to show that if I leave, you can expect to still have 80% there. And again, I'm going to just say that sometimes you can't get that number, or you don't know that number, or it's just impossible to calculate. So again, this is one of the areas that businesses are looked at. So if you are able to calculate that, then it really helps a potential seller or buyer. We then look at what is the lifetime value of your client. So I'm going to use some of our numbers as an example. We typically, once we have a business that we are doing the bookkeeping for, we retain them for up from 4 to 9 years. So when I sign on a new client and I know what the monthly amount is, then I know that I should expect them to be with us for 4 to 9 years. And there's a whole bunch of things why it ranges from 4 to 9 years. Most of the time, they leave because we've helped them become profitable and they're ready to hire someone in-house. And they no longer need us to do it for them because they're like, hey, we're making enough money now that we can have a person who's here for 40 hours a week instead of just the time that some of our numbers keeps up on our bookkeeping. Or in the sense of fractional CFO, it's like we get them over the hump and they're like, thank you so much. That's exactly what I needed. And I'm good to go on my own. So for you in your businesses, you can say, all right, is this a one and done, or can I expect them to come back? Think about the real estate market. If you're able to sell someone a home, you're hoping that you get to retain them for when they end up selling later. So, but think about your client list, and if you're able to identify what is the lifetime value of having that new client.
So, quick question, Michelle. This is something that's come up with our company because we're a home improvement contracting company,
Yes.
and it's frustrating because we're not a subscription service. We don't have that recurring revenue. So, but the fact of the matter is, we do keep good track of like what percentage of our business is actually returning customers, so we can show that revenue, and we have a really strong track record of repeat business and referrals because we treat them right. If I'm going to sell my business, how can I position that in such a way that it really accentuates that so they understand, yeah, we're not a subscription recurring revenue business, but we do have 26 years of good, strong repeat business track record. I mean, how do you even package that or say that?
So a lot of the times it's happening in a negotiation, just like if you're buying a car. We've taken really good care of this. We go and get it washed all the time. We have this. So it's going to be part of the narrative and perhaps not something that can be put on a piece of paper with data that is behind it. But you can show that we've been around for 26 years. You can see our reviews. Sometimes it's a matter of just saying the reviews are good. You can see that if you want a reference or whatever else. So it becomes outside of the actual numbers or things that you're tracking that you could prove to someone, but you still are able to have that conversation.
I guess what I'm asking is, I mean, have you ever seen a company actually track it with numbers? I don't want just goodwill or words here. I want somebody who has hard data that says, this year or for every year, 30% or 40% of our revenue came from repeat business and or referral work. And this is our average whole life value of the customer. You can see they've got multiple purchases. Have you ever seen anybody do that to try
all
to
the time? All the time. This is when you realize that that is part of the value of your company and you're trying to push your team, or if it drops off, it's going to really hurt your business. You definitely track it. You track it and then you hold people accountable to it because it's going to be something that's going to be necessary. Like, what happened? Why are we losing people all this time? For 26 years, we've never lost. What happened? And then, yes, anything you track is something that is, if it is critical to your business, yes, we see this all the time. And I'm going to call those KPIs that you are, key productivity indicators. And yeah, we see all sorts of things tracked, especially when it comes down to how the success of your business. Yes.
That's something
Okay.
my franchise does. For those that don't know, I own a quick lube oil change franchise location, and we know repeat customers. We know how much they spend, so we can actually run reports and see how much repeat customers have spent and how much new customers have spent.
Yeah. The other thing is when we look at how much money does it cost to acquire a new customer, if you have repeat clients, you don't have to put much into it. I've got a pool service business up in Montana that we work with, and they don't do any marketing. Zero. We spend nothing on it at all because they've been around for long enough and they know exactly where how they're getting their clients, and it doesn't cost them to acquire it. Their reputation is so strong in that industry. So their client acquisition costs are just very, very low versus other companies where you have to have marketing and advertising in order to be able to acquire a new client. So you look at this, and Aaron, if you look at this as well, of how do you say that how much should I put in marketing and what type of marketing should I spend, and do ads even work? This goes into knowing where your clients are coming from, and if you retain them, then there isn't it's not necessary. So for us, knowing that the retention rate is so high and I expect to keep them there for 4 to 5 years, I've got a full-time position that is Aowen, who all she does is make sure that the clients are happy. That's her full-time position of making sure clients are happy and making sure we address anything where they're not happy. Because I know that if we let that fall off and we don't address it immediately, then my retention rate's going to go down and it's going to cost me more to acquire. So that helps you make lots of decisions internally, as well as passing that information on to a new new buyer. Aowen does a lot more than that, but that is the main reason that it's going to be at the top. Everything else takes second priority to that in the way her day irons out. So,
Michelle, I'm here to encourage you to move on to the next slide. I know
okay,
you have
thank
so
you.
many good things to
Yes.
share.
All right, thank you so much. All right, we're going to go into the stability now. And this is a little bit more of what things can really affect you. What are the risks that go into devaluing your company? So this is going to be a lot less in metrics, but for you to really have that narrative of what is coming, what is something that could really hurt your business and that you would have to overcome. This for me today is to point out for you, what things do I need to start working on? Because when we open our own business, we probably have all of these risks. We're going to go over them in detail. But as you grow and as your business moves forward, then you want to be watching this and trying to mitigate these risks at every step of the way, or at least have a plan B, is what I'm going to say on this one. So we're going to start off, and there's a lot of words on this. So you'll get these slides so that you can look at it afterwards. But the key man risk means there is somebody or several people that without them, the business would not do as well. A lot of the times it's the owner because they just know it. They created it and they had the relationships. So if you have a successful business, you have got to create operations where the company doesn't need you. That is a very, very big piece of the entrepreneurial journey. Can this business survive without me? And a lot of the times I'll say, can you take a 4-week vacation? And the business would still be okay. And it lets you see where your holes are. My daughter had twins and they were in the NICU for 7 weeks, and I left for 8 weeks and worked a very, very minimal schedule. It was the best thing ever to say, hey, the company's working great. And I knew exactly where all the holes were when I came back. And so then we came back and started shoring up all those. It might be a key salesman. Why is that key salesman? Well, maybe the key salesman has lived in the area for forever and they just sing your praises. And what if they pass away or move or whatever it might be? So look at any person, and we want A players, so don't get that confused. But if any person, it would immediately turn your business down or even fail, then this is something to be working on so that you don't have that risk. Next one is our key client risk. So I look at this in the sense of there are some companies out there that depend upon the government. Well, what happens when the government changes and it changes so radically? So if your key client holds more than 30%, it's like if your top 1 to 3 clients account for more than 20 to 30% of your total revenue, then you've got to look at that. And this also helps you in your business to know who you need to keep happy. But when you're selling, then it's like, what have you put into place so that you can say to the new owner, they'll stay with you. They're set. You don't have to worry about them leaving. But if you are worried about losing that top client because of you, you've got to do something and put it into place. It also allows you to see, all right, who else, what is going to affect my business now? And what other ways can we get around this if you only have a few that are bringing in that much money? These are some things that you can ask yourself that question. If I lost this client, would I have to lay somebody off? That lets you know that you've got a key client risk. So, or if the business is operating differently for that one person, one client, then you'd be like, uh-oh, if we lose them, or we wouldn't have to do this anymore if we lost them. That lets you know you have key client risk as well. All right. Now we've got what we call single channel risk. And again, I hate that there's so many words on this page, but I know that you're going to get the recording. So I want you to have this data here, and it's important to know all the pieces because you're each in different industries. But when you look at this, this is when your company depends upon only one way or channel of getting the revenue. So we've seen this in now, what have we seen? People that are completely dependent upon China. There's a lot of businesses in the e-commerce space that they're going under because now with the tariffs that have gone into place and they have no other way to get their materials that they need, it's affecting their business. So they do have this single channel risk. Other things that we saw in place was that Google changed their algorithms a few years ago, and people that were making a ton of money by running Google ads, all of a sudden when the algorithm changed, it just went in the toilet and they could never recover their business. And I saw more than once that businesses actually went under because they did not know how to acquire their clients because all they knew was Google ads were working and they couldn't figure it out afterwards. So you might look at all of the systems that you have in place by the way you get revenue, but also how you get all of your business out so that you can say, does my distribution or do my sales, are they dependent upon one way of doing things? I think, when we look at people in Europe, when the whole train system, they go on strike, how it just shuts down things completely because they're so dependent upon their trains. So, all right. You can also, there's some calculations here. And then I'm going to just say that if you don't have a backup strategy and at least considered it. So these tariffs were something that at least there was a backup strategy. It wasn't beautiful and people didn't want to, but they at least could, their whole business could continue to operate and with making other adjustments as well. But sometimes there is no other adjustment. All right. Then we've got our market risk. So we see this especially in real estate run things that when the market changes and interest rates go up, then our business takes a hit. So people who do mortgages for new homes, then in times of plenty when interest rates are low, then there's a ton of mortgage companies out there. When interest rates go up and they don't do refinances, they only do new ones, then that goes even refinances for that matter. Then they all go out of business because they no longer have there's not enough business out there because of the market. So looking at this is, do you have things in that with the economy are going to make a difference for you? So one of the areas is that if you have a service that is spent with discretionary income, what else can you offer so that when people don't have discretionary income that they can overcome it? And then do you really know if it's discretionary income or not, which is the interesting point dealing with a client that did fine jewelry. I said, well, what are you going to do as the economic downturn? And they said, do you know that during the Great Depression, jewelry sales remained level? I'm like, are you kidding me? And she said, yes, that is data out there that women and men still purchase jewelry even when the economics turned down. I thought, well, that's great that she had that data, and maybe it was a certain type of jewelry, but whatever it was, she knew exactly what that was. So look at what are we dealing with right now? Regulatory and political changes. So with our new president, he's put into play that if you have green energy type of things, which was hot and people were spending a lot of money on that, he's taken away a lot of the incentives for that. If your whole business was based upon that and now that is gone, then perhaps that would be facing you as well. I love the part as far as market thing was, for those of us old enough, remember the days where it was like if it had fat in it, it was like you wouldn't buy it. But anything that said fat free, even if it was like had more calories and more sugar and everything, but the fact that it was fat free, I remember seeing it on a package of licorice. Fat free. I'm like, are you kidding me? It's licorice, but that was the hot thing. And then what happened? Carb free, protein, whatever, sugar free, or no natural preservatives, whatever it was in that industry. As soon as the market changed or some science came into play, then it changed completely. And look at what has happened with disruptive technologies. AI is now here, and if you are doing something that doesn't use AI, then you might be out as well, or if AI can replace. The last thing that we're going to talk about here is our data risk. And this goes back to what Aaron brought up, is that does the data that you're producing for a potential buyer, is it sound and can you prove it? So a lot of times the things that bring it into risk is if there are errors in your bookkeeping, or you have no bookkeeping, or it's on a spreadsheet instead of in a software. If you have customer data that's missing, or you can't produce all of the contracts that you're in with clients so that they see what else they might be faced with, or if it conflicts. So this is what the profit and loss says, but that's not what's showing in the bank account. All of these things, and I hope that if you are buying a business and you saw this, you'd be like, whoa, 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 whoa. I got to see some more things here, because I don't know if I trust this, and I don't know what I'm going to really be in risk for. So unfortunately, I've seen a lot of businesses that have been purchased based upon faulty or incomplete data. And then as the new owner takes over and they are coming to us for help in getting their business profitable, they're like, I had no idea. They hadn't been taking care of this, or we never saw that, or the business owner just didn't track it, or whatever else it might be. So the more data you've got, the less risk that you've got in your business. This also is when you've got things where human error can cause we in our industry are like, you've got fat finger syndrome, because we were looking at a set of financials, and normally the amount was $4,000 and it happened to be $40,000. And we looked at it and immediately said, either you had a really good month or somebody had fat fingers. And immediately they're like, oh, that was fat fingers. We added another zero to it, and that was where the error was. Okay, this also piece is, how do you prove it? And that's where the due diligence comes in. When you are selling your business, there has to be some due diligence. And if that's harder, or it brings up more questions than answers, that can kill a sale as well. All right, so what do we do at the end? We take that EBITDA number that we talked about, and I just grabbed, these are all fake numbers. I just put it in here. And then we say, what is the multiplier? And a multiplier is a number that gets pulled out of thin air based upon all of those risks that are there. And again, there are companies out there that tell you what the multiplier is. And depending upon who they are and what they know, they'll give you a good multiplier that is based upon those risks and other industry factors. So in the accounting arena, the multiplier is usually around 1, and it only goes down from the 1. In the preschool arena, the multiplier goes up to 5 based upon, or in technology, it goes up to 5. And so these are all over the place, but the multiplier is made up by those risks there. And the lower the risks, the higher the multiplier can be. And then you come up with a value. 785, 221 times 2.5 is the multiplier. Again, this is very squishy as far as what that multiplier is. And then you've got your value. At that point, then you have a discussion over, yes, now in the dentist office, you're going to keep all of the chairs and the x-ray machine and the front desk furniture. So if your business, if the vehicles come along with it, or all of the desk comes along with it, or the software or the computers or the photocopy machine or whatever else you might have, then you go and say, and you're going to get these assets. And most of the time, the asset value is going to be what the fair market value is. How much would it take to purchase that right now in order to replace it? Or what is the value, the fair market value if you sold that photocopy machine that's 10 years old? And your assets might be at 0. But this also is a place for negotiation as well, to say I'm not including my assets, or I am including the assets, depending upon what the situation. Then you get this number here. My valuation of my business is 2,164,000. Well, what does that mean? It's where the negotiations begin. And if you are a seller, then you do everything you can to have these negotiations be high. If you are a buyer, you do everything you can to make this negotiation number starting point be lower. And then the discussion begins. Well, I see it here, and I'm really concerned if you're not the one here because been the one running it for 60 years, and now you're not going to be here. Why would people stay here? Or whatever all those other risks are. So this is, again, not meant to be it's where the price tag starts and then where the negotiation is. And it also is a way for you to then say why your business is worth the person next door. When I was thinking about examples, I thought, what is a house worth? Well, the house has very constricting pieces that are part of that. And there has to be something in the market that says that's what on this block, this house is worth this. They use that as comparables. Well, why is it so strict and constrained in the housing market? Because most people are not buying houses for cash. They've got to go get money from the bank. And so there has to be a way of saying, nope, that's what it's truly worth. And if there is a place where you're going to go into foreclosure, how much can be retained from that? Very different than businesses. So comparing your business to buying a house is not relevant at all. A business have all these other pieces in there. But if everyone has an e-commerce business, your business might be worth 0, because why do they need it? And so you can go through and say, I don't need any of this. Again, why? So what makes your business valuable is showing that without this, you wouldn't have this amount of earnings.
All right. Thank you all so much for being here.
Thanks.
Hope to see you